Hi student, today I'm going to discuss chapter 13, Irrecoverable Debts and the Provision for Doubtful Debts. What is different between these two? Irrecoverable debts, we also call it bad debts. Bad debt means that we could not collect back the money that trade receivable was owing. Okay, so for instance, our trade receivable owe us about 1,000 and suddenly they are run away and uncontactable or declare bankruptcy. So in this situation, they are not able to pay you a single cent. So in this situation, our company will treat it as our losses. So we claim it as bad debt and to balance the accounts, close the account with the bad debts transaction, and also we record this as part of the expenses in our income statement. Provision for doubtful debt means that estimated of the bad debt. Since there is the bad debt happens, so we could estimated the following trade receivable according to their payment trend, the record, then we can estimate how many percent from them might be bad debts in the coming future. Okay. This chapter, I'm going to cover the introduction, what is the bad debt, what is the provision for that debt, and the details of the journal entry for irrecoverable debts. And when there is, once the irrecoverable means that we close the account, um, declare as the losses. So what if the bad debts and now, the previous bad debt and now recover? Debt recovery means that previously we can't contact or the trade receiver already run away, uncontactable, declare bankruptcy, and be very sure that we could not get back the monies that they owe. So we close the account and claim the amounts owing as our losses. We bear it. But now, after certain years, suddenly they wanted to pay partly or the whole amounts that they previously owe. So we need to reinstate back the amount owing, or we open a debt recovery accounts to balance the bank the check received or the money received. Provision for doubtful debt is, as I said the previous page, this is our estimated losses on the bad debt. Like we try to estimate, predict how much I might lose from the bad debt in future. To do this, we need just because we need to follow the prudence accounting policy, accounting principle. Do not overstate our profit and do not overstate our trade receivable. Income statement and SOP entry for bad debt and PDD. PDD is the provision for doubtful debt. So once we done the T account or the journal entry for the bad debts and bad debt recovery or even the PDD, we need to transfer to the income statement and the statement of financial position, which is SOP. So I will illustrate the T account, the journal entry with the transferring of income statement and SOP entry. Okay, what is the bad debt actually is? So when the goods are sold on credit, the customer is allowed to pay the goods later date. What does that mean? It means that if goods sold on credit, the term on credit means that I allowed the customer pay later and they can have the goods that they ordered. Okay, so once they sell the goods, they have the money, then they pay us. So usually in our current markets, everyone's doing this. So for the convenience of the customer and also for the favor of the customer. So there is always a risk that the customer may not pay for those goods. So once you offer the good sold on credit, they will have the chances of not collecting the money owing by the credit customer. We call it trade receivable. And irrecoverable debts is an amount owing to the business which will not pay by the credit customer. So if all reasonable steps to obtain payment still fail, the debt is written off. So like I calling, I email, I even go to their companies to collect the debts, but still they are not paying, or they are uncontactable. So in this situation, we should balance the account and declare this as a losses, and it will appear in your income statement and claim that as expenses of that year. Whereas the written off irrecoverable debts is an example of the application of the principle of prudence. Prudence means do not overstate the profit for the year or the asset. Asset included your current asset, which is trade receivable, appear in under current asset. So your current asset will need to the trade receivable need to minus the in the account need to credit out the amount owing as a bad debts. I give an example.